Thanks for coming today. This event was originally supposed to be with the now nominee for the Federal Reserve Chair, Kevin Warsh. After he got appointed a couple of weeks ago, we had to switch it around and have our two lovely professors that I admired greatly here at the GSB talk about what things might look like, both in terms of Federal Reserve, but not limited to the Federal Reserve, both generally under the economy and how governance of the economy may be changing and how banking and finance might be evolving as we go ahead as well. Before long, I want to once again thank you for coming, and I want to kick off with the Federal Reserve because that was the elephant in the room in a way. Considering the changes that we might see in the Federal Reserve's governance, would you think of not just the Federal Reserve, but central banks in general, that hold a very special place, especially since the GFC? They've taken up more space, as Kevin Warsh himself also mentioned, in the public space more often than not. How do you both sort of see that has evolved and changing? And in that, I want to ask Anat, where do you think we are today? How we came to here from the GFC, or even before the GFC, what the Federal Reserve itself was like? And for Amit, I want to ask you about today and the future, because I think you have thoughts on what might the new world look like under the current changes. Thank you.
Thank you, Tunc. That's one of our awesome leaders. And he's also teaching a class in which Kevin Warsh would have come, maybe even virtually, but he canceled that as well today. But he's been coming for 11 years straight, the only one who's come straight to my classes ever since I started teaching about the subject of today's talk, basically, of today's session, basically. So where we came from a small pre-crisis, GFC, global financial crisis, to anybody who didn't know the acronym. And the Fed was under $1 trillion in balance sheet before the 2008 financial crisis and before it embarked on policies that Kevin Warsh himself did not approve of at some point after the crisis, was called quantitative easing. And so the Federal Reserve is a central bank. There are central banks all over. For every currency, you have a central bank. And there are, these complicated institutions intertwined with governments and kind of operating, interacting through banks mostly. And they do what they do, which is usually just kind of help make sure that the banks have money in the ATM, that, if they just have a liquidity problem, they'll give them support to make sure that they will have the money to operate, just smooth things out like that, preventing panics and all of that. The Fed took a lot of huge steps once after Lehman, even before Lehman, with Bear Stearns, it started getting involved. And that's the Fed itself. And then it let Lehman fail. Lehman was an investment bank, and then it pulled out all the stops. At that point, it was like the courage to act. As Ben Bernanke would say, they came up with every single measure to make sure that the world financial system doesn't implode. And in that process, they started buying a lot of security, making loans to all sorts of institutions, swap lines to other central banks, very, very active at that point. And then Kevin Warsh at that time, apropos, our absent visitor, resigned from the Fed because he did not approve of those expansions of the Fed balance sheet. And that's when he started visiting more frequently here. And so there's a lot going on from all his visits over those 11 years. And in 2020, when COVID came, the Federal Reserve also took an enormous, even bigger gulp in terms of, opening up the same facilities and more to support, money market funds and Main Street lending and buying corporate bonds, or at least being willing to, and buying more securities and all kinds of things. And so it grew ever more to 9 trillion and now reducing. So one of his things was about reducing that size. So that's part of where we came from in terms of the Fed. And Kevin Warsh was often saying that, the Federal Reserve was not on the front page of the papers for years. And then it became front page and sort of they liked it and they want to stay in the front page. So they became more important in the economy, maybe the only game in town, somebody called them. So when the politicians don't want to do things, they'll string in and do it. They do it in the UK, Bank of England steps in, Lehman moments, whatever. And so they just active in, and because they can, and because they want to, or because they have pressure, or any number of reasons, they intervene in markets because they have a lot of capacity to do that if the law allows them. So here we are. The Fed is important. Every word of Kevin Warsh today would be parsed, and so in that sense, the two of us can speak a bit more freely than he can, and so you're getting kind of that poor substitute, but at least more free to say what we want, what we think.
All right. So thanks. Sorry for those who wanted Kevin Warsh. You got to do with this. Thanks to Cassie for hosting this anyway, because I think this is obviously a very important topic. I usually give great ideas, I know. So I think it's important to step back and sort of acknowledge that Fed has been an incredible institution over the years. If you look across the world, it's the gold star that everybody is hoping to mimic. There's a secret sauce around it, and that secret sauce we call independence. But a bunch of stuff comes with that term. So what I wanted to do was talk a little bit about what this is, and then going forward, like you said, what might happen. So independence comes from credibility, and credibility means good governance. That feeds into the class that both Anat and I teach. And I think independence, you got to earn it. You can't just assert it. That is something that's been going on right now from both sides of the aisle as far as politics is concerned. So if you look at what Anat said, and if you broaden the time horizon, there is a mandate that Fed has, and we'll talk a little bit about it. But it has stepped way past its mandate. Some of that is way outside its expertise, for example, climate. That's not to say that climate is not important. That's an important issue, but Fed can't solve everything. But we somehow got to a point where Fed decided that it should be doing all this. And that's why it's important to remind ourselves, okay, what was this independence? What was the mandate? The mandate was monetary policy. That's what got us the gold star. And at some point when we were doing monetary policy, we realized that, well, monetary policy, of course, goes to the real economy, but it also intersects with the financial institutions. Banks, which is what was synonymous with financial institutions, that's a topic that we'll hopefully talk a little bit about because that has changed. So then the argument was, okay, monetary policy, but there is also these financial institutions which help transmit the monetary policy, so we got to do something there. And what is the problem? The problem is there are a lot of panics and runs and welfare losses which are sentiment driven. So, and we'll probably get into that. So the Fed has to do something to make sure the monetary policy mandate is fulfilled. And in came the notion of lender of last resort. Okay, you might have heard of this term. And the idea was, if it's a liquidity sentiment oriented event where markets sometimes do things in the short run, we are going to come in, and because monetary policy might be affected for reasons which have nothing to do with anything but sentiment, we are going to intervene. But there was a clear line as it's called the Badgett rule, where we are going to intervene if it's a liquidity event, but we are not going to intervene if it's a solvency event, which means if the bank has made bad loans and is going down, it should go down, because that's not our job, and they made bad decisions, so they should suffer the consequences, okay? And at some point, we decided that we are going to do way more than what this liquidity solvency thing was. But that's the reason why Fed also does supervision of banks, because, hey, how do you figure out that there is solvency versus liquidity, especially during a crisis? So you got to give them some power to look at the banks, what's happening inside, and so on, so that when time comes, they can separate out liquidity, sentiment-driven stuff from solvency, okay? But that's very important that they do this magic somehow. Problem is, when you do all this, it has resulted, and we'll get into hopefully, two things. One, the whole financial stability and supervision is now something that constrains what I can and cannot do as Fed with respect to monetary policy. So in 2023 crisis, when banks were at the cusp of going under, and the reason was high interest rates, we couldn't raise the interest rates even though we wanted to combat inflation, potentially. So that's one thing. The second is, if you screw up, and I'm guessing screwing is okay, even though this is live stream, if you screw up on supervision side, that has reputational spillovers on credibility with respect to monetary policy. So if you look at what Anat said and combine with what I said, we are standing today and looking ahead, and that's what Kevin is faced with. Number one, with respect to lender of last resorts, we have a clear too big to fail expectation in the market. Everything is too big to fail, okay? Any problem, they are going to intervene. It's no longer about liquidity versus solvency. But remember, if we decide to save insolvent institutions, and we have done that, it becomes a fiscal problem, because we are backing it on the behest of US's balance sheet. But Fed never has that mandate. So when it loses credibility and people question its independence, there is a reason. And both administrations have done that, Democrats and Republicans, over the years. And the second thing that I already told you is that financial stability issues have clearly creeped into monetary policy decisions. We didn't raise the interest rates as much as we could. So going forward, I think it's a problem that Kevin faces, hopefully based on the 11 years when he's been here and he has consistently said a bunch of stuff. I think he wants it to be more rule-based, he wants it to be more transparent, and at the end, it's going to be about accountability, right? So as someone says, maybe I said it, you need three things. It's accountability, accountability, accountability. Accountability on lender of last resorts, that if you say it's liquidity, how do you prove it to the people that this is about liquidity and it's not about a zombie institution that you keep alive forever? And if it is about emergency lending that they are doing, how do we know that this was just not you saving someone, but really a liquidity event? And number two is, any action you do, how do we know that it's only about monetary policy and not about mission creep? So I think that's this fundamental challenge, and hopefully that relates also with what Anat said about QE and other interventions they did in the post of financial crisis.
Do you have anything to add?
So yeah, Amit, they've stepped into my lane, which is financial regulation and stability. So I didn't say kind of what I would always say. You know, the banks are weak, and what this is not about sentiment that's just liquidity, but sort of legitimate concerns about solvency. And there's a long history of bailing out insolvent institutions, and when they get to be very large, they also have enormous sources of profits, because at that point, they're basically above the law. They can do all kinds of things with no accountability whatsoever. When you're JP Morgan Chase and you have $2.5 trillion of deposits just sitting there. They won't run because it's J.P. Morgan Chase. No, they're unsecured. Then you can just borrow as much as you want. You can grow almost as much as you want. You get to be, the sizes that many central banks don't get to, like $4+ trillion. And then your business is all over the place. And, now there are the regulators. So Kevin Warsh is on the record saying more than a decade ago, and then repeatedly in my classes, that the largest banks are not transparent and not well governed in the sense that, you cannot understand the risk from their disclosures. So he was always saying it's a black box. When I read the disclosures of a manufacturing company, I know what I'm looking at. But when I look at the large banks' disclosures, and other people have tried, savvy investors, black box, the footnotes, the netted derivatives, all this stuff, you cannot, they might have 300 pages and they're not giving you enough information. So the regulators can do more there. The question is, do they do more? And whether central banks are, like the Fed, are in a position to fail as regulators, which the Fed has repeatedly failed, including on mortgages, which they were the sole authority to do on a federal level before the financial crisis, and failed so spectacularly that was taken away from them and given to a new agency, CFPB, which they're now dismantling. Does the Fed have the right instinct, the right mindset, the right political will to be a regulator? It is well thought, but not in every country, that central banks should be regulators. But that's, in my observation, I don't think it's in their DNA. But part of it is that they can always cover up their own failures and the bank's insolvencies. And so they're not there. If if you had the FDIC take seriously their having to hold the bags on failed banks, rather than rely on the Fed to make sure they don't have to face trillions of dollars of losses, then you might get some people whose mind is in the right place on risk. But the FDIC is a tiny, unimportant regulator in this sphere. The Fed is somehow the main one on the biggest banks, and they routinely fail, and they routinely get away with it. So the Fed on the regulation side gets low marks for me, and it's a problem because they were charged under the Dodd-Frank Act, Title I, with solving the too big to fail problem. J.P. Morgan Chase was at the time, $2 trillion total by GAAP measures. A lot more, like $4 by IFRS, rules, accounting rules, and it only doubled in size since then, and somehow that's okay, but it's not supposed to be okay. So they just fail under the basics of financial stability and removing too big to fail, where they have every authority and every legal tool to deal with it. So on that score, I don't know that Kevin Warsh cares about the regulation. Everybody talks about monetary all the time, but the Fed is one of a number of regulators, and it's really repeatedly fails. SVB being just one example recently.
I want to go back to a point about stability and something, Amit, you said about banks and financial institutions used to being sort of equivalent, but that may not be the case anymore. We're at a point where there are other non-banking institutions that are occupying the financial space that is creating risk that is perhaps not properly captured by the regulators, both in terms of crypto, but other sort of private capital, private credit, and other assets types. Where do you see that going? And do you if you were a regulator, would you try to go out and regulate that space, especially surrounding the private capital arguments around private credit being private and not public, not needing as much regulation because the people are in those transactions are qualified investors who understand the risks they're taking?
Yeah, there's a lot there. I think just to close and then connect with what you're asking, close what Anat said. So I spoke about lender of last resort and supervision that Fed does. And what Anat is basically arguing is that, look, supervision is not just done by Fed, it is also done by others. Actually, they are supposed to be doing a lot of supervision inside a bunch of banks that, like Silicon Valley Bank, but the biggest ones are under Fed. And that's where the tension is, who is accountable, who's not accountable. There's a lot of that going on. Similarly, on the bank side, as if you took Anat's class, or if you know about banks, you know that they take a lot of subsidized deposits. That's chunk of their funding. So if they are not internalizing the risk of failure, and regulators are fighting or doing whatever they are doing, and there is no accountability there either, and every time we intervene, we basically are saving everybody on the back of the US balance sheet implicitly, this is not necessarily going to look great. So whether or not Kevin Warsh likes it, I think he will have to tackle it anyway, because monetary policy transmission has to go through these big guys, and how do you deal with them in a way that is sensible and where they think about risks, all the big banks that Anat was talking about. So, okay, so that's just closing that. To your point about non-banks, private credit, crypto, I think these are real risks. So banking, like Anat said, we have a pretty highly leveraged banking system. Every bank takes 95 cents on a dollar through subsidized loans. And they are subsidized, so that just makes it enjoyable for them. But that's the system. So we can say that, okay, we don't need that. We have a parallel plumbing that we will do, which will replace this. So income non-bank, income private credit, income's crypto. The problem is, if you dig deeper into each of these entities, you will find that it's the same problems: opacity, lack of disclosure, lack of transparency, lot of leverage. If it's not there yet, it's getting there, and just a different wrapper around. So in the case of crypto, it's tech. In the case of private credit, it's private equity, and so on. But ultimately, it's the same fundamental problem that you're going to see in many of these things. What is that? There is high amount of leverage, and there is maturity mismatch, which is we take short-term credit or deposits to give us funding, and then we employ it for long-term stuff. So if you think about private equity, and if you've taken private equity classes, the amazing thing about private equity model is you take long-term liabilities. So you go to endowments, pension funds, whatever, and say, hey, give me money for X number of years. Why? Because I will invest for X number of years in illiquid stuff, and don't ask me to give you payments on a daily basis. Don't stand outside my door asking for a deposit payment, because that's not our model. We want long-term money, which we'll employ in the economy in a long-term basis. So there is no maturity mismatch in that model. Everybody is an adult, so whoever is entering into that contract long-term better be sophisticated, to your point, and understand the risks. Because if I'm going to put money in Uber when it started out, don't expect me to give you something in return 2 days from now. It'll probably take 10 years, 15 years, who knows. So everybody understands the risk. That's why it's important for everybody to appreciate that. Now we get into a model where non-banks are big. Private equity wants to get money from retail investors who don't probably understand this. What are you going to get? We are going to again have someone step in to bail the entities when bad stuff happens. So actually, I didn't know that Bob Joss was going to be in the audience. Otherwise, I would have stolen this line and patented as mine, because I know that he said it long ago. It's correct. Anybody who knows and has spent time playing cricket, I think you said this in your last lecture long ago, that in cricket, it's a 5-day thing. You know, you go in a test match and you're like, what the hell? Nothing is happening. Nothing happens. and then everything happens suddenly. That's where we are headed with all of this stuff, because we are implicitly just backing everything on the back of US's balance sheet. So that's it's, I don't know if it's optimistic or bleak, but
Though, the question then becomes, does the public and the institutions have a duty to back these private assets because they potentially have leakage into public markets as well?
I mean, look, I have some views on this, but maybe we'll have Anat step in, because I think I want to hear what she says.
I'm personally a little scared because I think there's just kind of an expansion of the same problem, a very interconnected system, very opaque system. So you create another layer and another layer of shadow institutions kind of connected to other institutions, very hard to see through. And then you sort of end up taking, pension fund, retail investor money, and then, it's going to be a problem for lots more people when something happens. I mean, AIG was bailed out. It wasn't even a bank. It was an insurance company. Why? Because the way the financial transactions were set was going to actually impact, retail insurance customers. And then all of a sudden, it was impossible for them to fail. And then when they were bailed out, all their counterparties, the Citigroups of this world, got paid in full. So, because they knew how to structure the transactions to be ahead of other people. And so what you're not seeing is just the clever ways in which within that system, the savvy people are protecting themselves, and the end investors, either they are depositors or they are some end investor, retail investors for pension funds, are going to end up, being harmed when this whole house of cards kind of implodes, and that could happen. So the scale of a crisis that we would say 100-year flood that suddenly happened could be some people say on the scale of the 1920s and 30s. That somehow the 2007 to 9 crisis was not big enough to truly impress people because they sort of were able this time to pull out all the stops which they didn't do in the 30s and prevent a bigger harm. So we kind of said, oh, okay, it was only a Great Recession, but it wasn't a depression. So we're not going to seriously learn a lesson, because after the Great Depression, I mean, all kinds of institutions were built that are being eroded right now.
I'll just say one thing, which is, it's related to what Anat said. If you look at all the retail investors in the US, and that's the pitch that a lot of private equity folks and also some consumer advocates have, that why should we have such an untapped source of wealth? We don't have any sovereign wealth fund in the US, which could actually go out and earn returns for retail investors. You need assets for that. And so the retail investors should be allowed to participate. There is some element of reasonableness to that, but because we have a system which has worked with opacity, it's difficult to understand. This whole maturity mismatch may come second nature to all of you because you've heard it or thought about it. It doesn't come second nature to a median retail investor in the US. What's the meaning of maturity mismatch? So if you have a crypto fund, which is basically doing the same thing, or if you have a private equity, private credit, which takes a bunch of retail money and then puts it to work for 10 years, it's the same thing, but do they understand? So there is risk in this, right? Not everything pans out. We are all in Silicon Valley. We know venture and PE. There is risk, and that's why there is high return. But if retail investors understand that, that would be fine. But historical data on anything about financial literacy tells us most people don't understand this. So then what's going to happen is Congress is going to say, hey, someone save them. And who's that someone going to be? Fed. That's why we are talking about it.
And Treasury, because oftentimes in the bailouts, the Treasury ends up backing up the Fed, which has happened, exactly, which happened, in both the financial crisis in COVID and then again in SVB. So that's kind of, you don't see how they all interact. The FDIC would bail out all depositors, and then they will tax the surviving banks who have a lot of capacity to pay. They'll grumble but pay. So FDIC kind of can sort of sleep at night. And then the Fed is throwing at lots of people, and even the FDIC sometimes will throw money at non-banks, guaranteeing debt or things like that. And then the Treasury is sort of saying, okay, take risk, we'll be behind you. So there's always sort of this pact going on, and it's hard for people to see how they kind of manage to say, oh, well, it's not a bailout, it's not a bailout, but it is.
It's funny you mentioned both of you. You need assets for that, and Kevin Warsh also has been on the record trying to say that the Fed and the Treasury could do a swap between the mortgage-backed securities in their balance sheets, so that Fed can have more control over its duration and whether between T-bills and MBSs, shorten it, but also the Fed can get rid of itself the fiscal responsibility that it had taken. That I don't know if you would agree, Amit, or not, about whether that was a mission creep as well into the fiscal space.
I think, like I said earlier, that's why I wanted to lay it out so that we can discuss this, because getting into swap lines and what we save, what we don't save, is great for people who like to talk about it, like Anat and me, but maybe not so much for a general person. But at the big picture level, it's again about, there's a bunch of things we should do. Treasury should not be intervening in there, because Treasury is all about fiscal side. We are all about monetary policy. So anytime we are going in there and asking for support, we are doing something strange. That's why we started calling it unconventional monetary policy, for example, right? Like, it's not conventional. And we are paying for it in different ways. Like the Fed balance sheet grew to 9 trillion, now has gone down. Kevin Warsh has talked about this. What did we do with this? Well, we went out and bought some assets, and then of course Treasury had to play a role. Similarly, like Anat was saying, during COVID, we went out and Treasury had to support, because Fed doesn't have the capacity, unless there is someone else supporting it, to buy and sell these trillions of dollars of assets. And maybe we want something like that. Maybe Fed is our sovereign wealth fund, but I don't see any discussion in the Congress about this. So back to what I opened with, which is about independence, this has been going on, right? This has been going on, and it's escalated now under President Trump, but it has been going on for some time, and we have not solved this problem. We have made it worse. Too big to fail was coined when? Back in Continental, which was before most of our MBA students even knew what a bank was. But yeah, so I think we got to solve this problem.
Yeah, I mean, there'll be big challenges ahead. Donald Trump wants low interest rates, but he also wants them for mortgages. Mortgages are not short term, so there's an issue there that conflicts a little bit with the way Kevin Warsh talks about those QEs. And so we'll see how much they get discussed, and then what happens when, everybody has to live with what they said they would do, or come to terms with what the other is doing and saying. So the show is going to continue. It's going to be interesting.
I want to take a step back, because we're talking about systems that are inherently very complicated, as you mentioned. But this is all part of a social contract. The economy exists for the people that it's supporting, and finance is supposed to have a role within it to support the system. How, I don't know, if you want to sort of comment on this,
about this.
how that role has changed,
Stepping back is...
and whether what is supposed to serve as a tool for people and the economy itself becoming a part of economy that's a liability than an asset.
Yes.
I've been teaching this for...
Yeah. So thank you for going there, because I certainly don't want to get in the weeds of this stuff. And we kind of are drawn into this by these kind of discussions. But the key is, I've been here, over 40 years. I've been teaching my students finance for more than half of it. Just straight finance, starting with how awesome, the financial system is in helping the economy, do these basic things that help the economy, do a payment system, move money across time from savers to investors, from savers to those entrepreneurs and companies, and sharing the risk and managing the governance of corporations, all the good stuff. But the financial sector has become very extractive. And I think that if you dig behind some of our political problems right now, and some of the erosion of trust, some of the public anger, I think you will find that the financial, there was just an Oren Cass op-ed in the New York Times on the weekend about the financial sector. The financial sector is a grift in the headline. This is a conservative commentator from Compass saying it's grift and we should treat it that way. And he's talking about the financialization of everything and about, financialization taking over the economy. Everything is financialized. We now have prediction markets, people spending time speculating about the chances of Kevin Warsh being appointed because of our event or not. I mean, how's that productive? I mean, just the way where talent goes, where, finance is supposed to support the rest of the economy. Instead, it's taken over too much of the economy. So my view has become more negative on whether the financial system is doing what we need it to do at a reasonable cost or at an extractive cost from the rest of the economy, and also fueling, because of the kind of lack of understanding of the issue, fueling legitimate public anger.
Yeah, I think I don't think I can say it better because Anat has been talking about this. I think finance has done amazing things. Finance has led to growth for all the reasons she talked about. Payments, moving money across time, risk sharing, private equity, venture capital. You've seen all of that in front of your eyes. But it's pretty clear that there is a big amount of political entrenchment in the whole system, which makes it hard to function in a way that a good competitive system should allow you to do. So, for example, if you take risk, you should bear consequences of the risk, right? That seems like a reasonable thing to do. But the more we have Fed intervene, and why does the Fed intervene? Well, Fed is intertwined with the financial system. There are too big to fail banks. Too big to fail banks might try to influence the Fed to go in certain direction. Now, whether Fed does or not, that's its independence. But suppose it does, that stifles competition. That stifles entry. That stifles risk sharing. That stifles innovation. Suddenly, we now, when fintech came into town as something of a competition to banks did not have a great reaction because it's competition. We called a lot of these non-banks shadow banks because shadow from shadowy for obvious reasons. And then the question is, how do you balance this in a system? So over the years, US has done a great job in general of trying to separate these and innovate at the same time. But as Anat says, if the big institutions become very big and have an overarching influence on how the Fed and the system and technocrats and bureaucrats work, it undermines credibility of the whole system. And that's why you have a lot of problems. So finance can be great, but is it great right now is questionable if you ask a common person on the street.
I want to escalate it one more level, and then I want to open it for questions, unless you have something more important. And that is, there's more than just who takes risk and who bears the downside. There is clear, crime and corruption going on, too. There's money laundering. there's enabling of all kinds of things. There's fraud. So there's literally, I mean, fraud and theft are similar. It's just one is a kind of a nicer, slightly cleaner word. You know, if I reach into your pocket versus I defrauded you, you know, conceptually it's similar. But, you know, our book originally, The Banker's New Clothes, was about risk and who bears it only. And we said risk is good as long as you can bear. Yeah. So that was sort of the end of it. But we were talking at the end in 2012 about LIBOR. That was sort of the scandal of the day. But since then, I've dug more into issues that Amit actually has a lot of research on misconduct, on defrauding people. And my co-author is German, so I became familiar with a spectacular scandal that was perpetrated by a lot of European banks. And I have met the regulators inside, you know, Dutch National Bank or places where the regulators, you know, are in the central bank sometimes. And they have allowed for years the banks to literally rob the treasuries by creating this, what's called Cum Ex, look it up, scheme of basically a tax fraud where they created two receipts for a tax refund when only one was legitimate. And there was a lot of windfall to be shared with investors. And the estimates are now that European governments, this was related to a tax law in Europe, but there were participants from the US, you can be sure, investors, that about 150 billion euros were stolen from German, French, Dutch, Danish governments, treasuries, in front of the eyes of these regulators. So this is not, the regulatory failure is nothing special to the US, European, or, you know, and it's in the developed world here. We're not talking about even developing world. And the blind eye that they would turn to truly criminal behavior by banks.
I'll say one line to that, which is, I think we are not that far from where you're going. Which is, like I was saying, that if you take risk, you should bear the consequences. And I think usually when we say that, we assume that everybody's operating within boundaries of the law. So if you go outside that, that's, you know, that all bets are off. All bets are off. But what Anat is sort of arguing is that we have not only have we said you can take the risk and gains are yours, losses are taxpayers, but we can also allow you to break the law on certain times because you might be too big to fail.
That's above the law. So that was sort of, you know, how you basically lose control entirely.
I had one more question, but I'm looking at time, so I think I'm going to open up for questions. If you have a question, please raise your hand to our speakers.
So I love the conversation. Amit, you talked about wealth transfer in a joking way. But as Anat knows, I've looked into how the trust code is written by trustee lawyers and with our banks going into wealth management services and with the largest intergenerational transfer of wealth, somewhere in the neighborhood of 90 trillion, 95 trillion, these banks are playing regulatory arbitrage. No way is the Fed going to enforce the trust code of Florida, right? How does somebody like Kevin get a handle on the magnitude of harm and mischief that can be caused when the banks, when they deal with their own money or other people's money, now can do it across two generations?
Luckily, this is a question for Kevin. So Kevin, maybe Anat, you've known him for 11 years.
I will say something not about Kevin. I will say something much more general because it actually goes back to previous, Fed governors, but I will not name, okay? And that is when the Wells Fargo account opening scandal happened. I happened to talk to somebody pretty high up in the Fed, and I will not name. And in that conversation, I had the clear feeling that what was bothering people in the Federal Reserve was not as much that they were defrauding customers or investors, but that they were being fined by the CFPB because that depletes their capital. So profits are good. Banks' profits are good for the central bank. It's good for financial stability. So they will avert their eyes to how you got your profits. And that was a big insight for me because, there's a real conflict of interest because the financial stability mandate says that we like profitable banks. And if there's not enough business to go around, let them find some business that they can make money off. And then the system grows and they seem profitable, but how? So the notion of profitable misconduct is a thing. It is a thing in banking.
I'll just say that I think this is a very difficult problem. If I could give advice to him, it would be fix the basics first. This is a problem which I'm sure he has heard coming to Anat's class for 11 years. The scale is huge potentially, but the financial system is also doing a lot of good, right? So given how big it is and what it does and so on. So how do you balance the two things is not going to be that easy. So if you can get the basics right first, hopefully these more trickier problems can follow. That would be, but yeah, I'm glad he is the Fed chair.
Hi, I wanted to ask about counterparties, risk sharing, and interest rate. So I know you mentioned, I think it was AIG, where the counterparties, they all got paid, and then it's ultimately the taxpayers that bear the losses. And gains are theirs, losses are taxpayers. Is this something that's thought of when you're negotiating interest rates between counterparties and banks or institutions? Like this notion of too big to fail? And we just want to know your thoughts on this, if it's underwritten indirectly or if it ever comes up.
Well, look, I think we all worry about it. You might have heard of this thing called moral hazard. So this idea that we think you are going to be saved by someone and therefore you can behave in a different way and in a way that harms the other party. Why? Because if something bad happens, someone will take care of this problem for us. If you look at how things have evolved, it seems like people are behaving as if they know that if there are going to be losses, it's going to be nationalized and saved through the taxpayers. But then we let the profits circulate with you. I'll give you an example. We had Silicon Valley Bank, First Republic, very close by. Implicitly, we have backed all the depositors. So the deposits in the US system, you should think about US system is about 22 trillion-ish of banking assets and liabilities, and about 18 trillion is deposits. 9 trillion are insured deposits, like when we put money in the bank, it's insured up to a limit. 9 trillion-ish are uninsured deposits, corporate deposits, and so on and so forth. When that whole crisis happened, to alleviate the spookiness, we implicitly insured everyone. Now think about what your incentives are as a bank who is getting this money which is backed by someone. What are you going to do? Be prudent?
Life is good.
So it's not written anywhere, to your point, but everybody behaves as if it is.
Do you have anything to add? Thank you for the discussion. I'm curious, as people who know Kevin Warsh a bit more intimately than we do, your perspective there. You alluded to two kind of narratives. One is that he's an ideological hawk who wants to shrink the Fed balance sheet, and if you read his transcripts, that comes up for sure. The other is that he's kind of a naked partisan who only did that because he was in a Democrat administration that was going the other way, or in that environment. I'm curious where you think he'll land, especially since he's maybe pandered to Trump a little bit and saying lower interest rates. And then relatedly, how do you hope he approaches the Fed chair role?
I mean, I can say, you know him much longer than I do. I think, again, remember that Fed is a gold star institution for a reason. It survived over many, many years because it has a governance structure in place. Now, slowly we have eroded a lot of credibility, but it's not gone. It has a lot of governors. It has a lot of process in place. for a person to influence policy is very hard. That's how it's been set up. And to that extent, I think Kevin will have to basically manage the governance inside. I think if he's stuck with his principles, which I have heard, we'll get to a better place, I would think. But it's a challenging thing for obvious reasons that you mentioned. Now, is he more, does he have views which align more with one party versus the other? I think that's always the case, by the way. You know, when parties pick people, you would like to believe that they are all, neutral and completely. No, everybody picks people who are more aligned with them. There's nothing wrong with it. Question is just how do you balance what is the governance of that institution with whatever the person or party wants you to do. And Fed has done great over the long history, except I would say last 20 years. 70s, I think it was such a interesting period. And then you needed someone like Volcker to come in and establish the credibility, which lasted us for a bunch of. So maybe Kevin Warsh can be the new Volcker. But you would know.
Yeah, I want to hear more questions, but I would say, I don't think Kevin Warsh is a, real ideologue. I think he has pretty sensible views overall, and he'll have to manage. He attacked the Fed a lot recently, so that does not probably endear him on some people there. But he'll have to live with them and manage, this FOMC committee, the other governors. So, it's not a one-man show.
I think one more.
Thank you. If I may, I'll throw out two questions. Feel free to answer one, both, or neither. First, what do you think is the future of the CFPB? And second, a lot of the problems we talked about over the past hour are very deep, complicated, systemic. Are there any legislative solutions that you think could maybe fix any one of those, with the caveat being that given the money in our politics, it probably won't happen?
Anat, these are for you.
We just had Rohit, so I want to advertise an event. We have Rohit Chopra coming in person again for just an off-the-record lunch.
You may want to tell people
The 20th on
Chopra is.
Rohit Chopra was the head of the CFPB, and because that agency was created after the financial crisis, and it was created with one director, and as a result, it was even before Donald Trump fired lots and lots of commissioners everywhere. He was on the chopping block from day one, except he survived 2 weeks somehow miraculously. And we had him visit here last year, mid-February, after he lost his job in there. And he's actually a Wharton MBA, by the way, and an awesome guy. I'm a huge fan. And because of midterms, we didn't have an event with him and the SEC commissioner that was his buddy from the last Democratic SEC commissioner who just left her job, Carolyn Crenshaw, that visited my class virtually on Friday because of midterms. We couldn't have them in person, but he happens to be in the area. And the reason he's in the area, and it was publicized, is that he's working with some attorney generals of states. So some of these, many of the laws that the Consumer Financial Protection Bureau, CFPB, that you're referring to, was charged with kind of enforcing, can also be enforced otherwise, or states have their own laws. So a lot of the time when the federal government kind of drops the ball on some things, the states try to pick it up, and we have this debate about AI regulation, other things like that. So CFPB is still alive because of a court decision. It has also a special funding model, et cetera, through the Fed. And the court said that they could not, abolish it. So they're not abolishing it, but it's on a thread. And we'll see what happens. But CFPB has always been very popular with the public. And, there's just a lot of, there's zombie mortgages right now. There's all kinds of consumer protection issues that individuals are really powerless to solve. And you really need somebody to step in and protect. consumers in finance, and the CFPB has done a lot of good stuff there, just maintaining data and collecting complaints and stepping in to do stuff and enforcing. So, if it doesn't do it, the system might survive with some kind of, state action, but people are losing money and unable to fight it. So the hope is that it gets revived in some administrations down the line, and that's the hope.
So I think CFPB was created because the Fed was already doing a lot. And at that time, we did care about Fed not going everywhere and doing everything. So the challenge with many of the institutions, including FDIC, CFPB, is when you have a powerful entity like the Fed, and then you have these ancillary regulators, there is a lot of tussle and politics between them, and sometimes to the detriment of what we are trying to achieve. So I think even if this comes back, I think we need to have an alignment of what are we trying to do. Because right now, what was happening with CFPB, for example, and Fed, what they were pulling and pushing in the other direction, right? I want banks to lend more as a Fed because I want monetary policy transmission. And CFPB is like, don't lend because you're making these exotic loans and who knows what they are. So that tussle is eventually what led to whatever is happening right now. And part of it was we never aligned on, okay, what are we trying to do? And you could ask the Fed, why aren't you not doing it? If you really want to do supervision, you should be doing this. Look at Bank of England, right? Bank of England has supervision inside, but they have clear two parts of supervision. One does the consumer protection and one does the banking supervision. And they are basically aligned in that sense that, look, both have to be done. And the committees are accountable and what are you doing and so on. So we got to do that. But I don't know if we'll get there right now.
Unfortunately, we're out of time. I want to thank you all for coming, thank our speakers and the crowd on Zoom.